The Federal Reserve announces its first interest rate cut since 2020, signaling the end of its inflation fight. It's a move millions have been waiting for as Americans are facing the highest interest rates in more than 2 decades. But as Rena Roy reports, our wallets won't see an immediate impact.
A pivotal move from the Federal Reserve today, cutting interest rates for the first time in 4 years. The Fed reducing rates 0.5 percentage point.
This recalibration of our policy stance will help maintain the strength of the economy and the labor market, and will continue to enable further progress on inflation as we begin the process of moving toward a more neutral stance.
Americans have been dealing with high borrowing costs for everything from mortgages to credit cards. If you've been carrying a balance on your credit card, you've felt the sting of high rates, with the average APR now near 21% according to Bankrate. A rate cut could mean a slight decrease there.
You might just see a couple of dollars difference in your monthly payment due on your credit card, about under $10 a month less for that car loan, and about $50 a month on an average interest rate for a mortgage.
The Fed dialing back its years-long fight against inflation, which has slowed dramatically from its peak of about 9% in 2022.
We're now at 2.5%. We have dramatically come down, much closer to the Fed's 2% target. But look at here. The unemployment rate has ticked up at the same time to 4.2%, and that's what's troubling for the Fed.
The Fed remaining cautious.
We will continue to make our decisions meeting by meeting. We know that reducing policy restraint too quickly could hinder progress on inflation. At the same time, reducing restraint too slowly could unduly weaken economic activity and employment.
The good news here, this is expected to be the first of many interest rate cuts from the Fed. They could last through next year. Credit card rates could possibly be even 2 percentage points lower than what we're seeing today. Rena Roy, ABC News, New York.
Policymakers signal they expect to cut the key rate by an additional 0.5 point by the end of the year and envision 4 more rate cuts next year and 2 in 2026.